Hi there, Etoro. It is Monday, and that means it's time to take a look at what moved the markets last week. It's been bloody out there for a while, and that really didn't change so much last week. So the S&P 500 has fallen for the 7th consecutive week. There are lots of headlines out there. I'm not sure if you've noticed about records being set in various ways. This multi-month sell-off has seen the most shaved off of the US market cap, I think ever, even more than 2008 or the dot-com crash. So there are lots of stats flying around like that at the moment. And if we take a look here, these are weekly charts, by the way. So on the first one I have is the NASDAQ. So the NASDAQ 100 has gone through the same thing. So 7 weekly charts. We're in the 8th week now of drops, which is, it's not unprecedented, but it is incredibly rare. So here we have the S&P 500. Again, a lot of the heat has been taken out of the markets, as we all know, for a few months now. Just a couple stocks that I wanted to look at. So I did write a post about these last week. So this is Target and Walmart. Again, these are weekly charts, so you can see these big fat red candles. And this was when these companies reported earnings. So there was a bit more weakness than people had expected. And so once again, we saw multi-decade records being reached for each of these in terms of the amounts that they dropped. Now, I know a lot of people were surprised by the strength of these drop-offs, and there are also people saying that other companies within the same sector did better. And it's true. So Walmart, for example, did okay in terms of revenue. Their forecasts weren't so great, but the devil is in the details. And institutions, they hire armies of people to take a look at these details to understand how these businesses are doing. Now, I don't know why, but I haven't been able to find the same chart for the US. But again, the chart is very similar. So retail sales in the US came in quite strong at a macro level, right? At a country level. When we look at companies, we're looking at the micro level. But what's interesting to note is that the numbers that are published are not adjusted for inflation, first of all. So if your company is growing revenue by 10%, but inflation is 11%, then actually you're not growing your revenue in nominal terms, that is. But also the details, the more specific details, the more interesting detail is that, sure, the value of the retail sales has gone up, but the volume has been going down, or trending down. And this is because things are becoming more expensive. So people are buying fewer things. Well, that's the first point. So if a company is selling a widget and the costs to generate that widget are going up, they increase the price of the widget. Then whoever buys that, another company or a consumer, they're paying more for that thing than they were, a year ago. Now, if their wages don't go up by the same amount, then they're going to have to make some tough decisions about what they do and don't buy. So right now it seems that consumers are still spending a decent amount of money, but they're buying fewer things, which is going to affect retailers and everyone else involved in that supply chain. And also they're buying a different mix of things suddenly. So if the cost of your food is going up as well as everything else, you might not be able to buy other non-food things like you did previously. So you're redirecting your money towards food and those kinds of essentials that you need day to day. These types of things tend to be commoditized, so they're lower margin. So it means that the companies selling them are making less money from those things. There's a lot more to it than this. You need to read through the economic reports, but also the company reports themselves to understand all the nuances. But effectively what we're seeing is a slowdown in people buying stuff, well, especially non-food stuff, non-essential stuff. And this is to be expected, right? So inflation is driving the price of things up. And also with governments around the world increasing interest rates, the cost of debt is going up. So people are starting to tighten their belts, which is what central banks like the Fed have actually been trying to do. The challenge is, how do you tighten things up? How do you bring inflation down without causing the big R, a recession? And I'll touch on that in a moment, but first I want to talk about China. Last week we had some interesting data, economic data out of China, and the numbers were ugly. Let me zoom in here a little bit. So this is just a few of the numbers that were put out, but it's not looking great. They have been pumping a huge amount of money into the economy, and it seems as though they will continue to do so. There have been lots of public statements recently over the past few months that have told the world that the Chinese government is going to start making it easier to achieve growth within their economy. But they're not there yet. So you can see that everything is pointing towards a very large slump. My guess is that China has been in a recession for a while, but finally financial institutions and other types of investors seem to be changing their opinion when it comes to investing in China. But even if Chinese equities don't go any lower, they could be quite choppy for a while. It takes some time to build confidence after a protracted bear market. All right, so on to recession. So recession is the hot topic in the media at the moment, and you can see that it is a term that's been Googled more and more across the US, but also worldwide at the moment, and for good reasons. We can see that a number of the top-notch billionaires that have made their money in the markets have various opinions on a coming recession. Some of them are saying it's going to be the end of the world. Some of them are saying that it's already here. Some of them saying it might happen. Some of them are saying that we're already there. I'd just like to reiterate that predicting the future is very, very difficult. And the fact that there is such a variety of opinion across people that are involved in the industry should show you that. That doesn't mean that I don't respect these individuals. So Jeremy Grantham is a very intelligent man that's made a lot of money in the markets. But for example, he's basically a perma bear. So since 2010, he's been calling for an enormous bear market, and it will happen eventually, but so will an enormous bull market subsequent to that. I also just wanted to quickly look at the list of recessions in the US. So recessions can feel like a very big, scary word, but effectively what a recession is a recession begins when there are 2 consecutive quarters where the GDP of a country has shrunk instead of growing. So you can see the further back you go in history, there are some very, very scary recessions. But the recessions in recent decades tended to have been quite short and also haven't shaved too much off of GDP. Now, my gut feeling is that the US might be in a recession already, but I don't think it's going to be very deep or very, very long. And the reason for this is that it's not as though something within the financial machinery of the US or the world has fundamentally broken, not yet at least. The world has just experienced something absolutely insane. The whole world was locked down because of a disease that spread across the entire planet. This meant that governments had to do things previously thought completely infeasible in order to make sure that the world continued to function and to support the people in their population. And now, as that support has been pulled back, and because there's a war in the Ukraine and various other things going on, it means that we haven't seen the perfect rosy outcome that everyone had hoped for. And it now looks like the global GDP is starting to slow down as inflation is rising. And the things that central governments are doing in order to tame inflation, in order to bring it back, mean that GDP growth slows down or goes in the opposite direction, but probably only for a short amount of time. Now, as a long-term investor, a short amount of time obviously can mean several quarters, but let's say a recession does go on for 3 quarters, then we're already 2 quarters into that. I did want to quickly pull this up. So United States GDP growth. So I did mention on a previous video that GDP in the US in the last quarter did shrink, and there were some very particular reasons for this. But all that means is that we need one more quarter where US GDP growth is going in the wrong direction, and that means that the US will technically be in a recession. Now, if I change this to the full year view, just expand this out a little bit. So annual GDP growth is still strong, and this is another reason why I think that even if the US and other areas enter into recessions, that they probably will be short-lived. It's because a large part of the machinery that drives GDP is still fairly strong. But in order to deal with the levels of inflation that we have seen, the Federal Reserve in the US feels as though they need to push rates higher very quickly to make sure that inflation keeps on trending downwards. Now in the UK, the picture is slightly different. You can see that the UK number is actually still above 0. It seems to be trending down. The question is whether it will dip into negative area, and the Bank of England thinks that it will somewhere probably in the next 12 months. China, on the other hand, I know that some people won't necessarily trust this data, but China, on the other hand, seems to be slowly wobbling away from the weakest point of their GDP growth so far. So what I wanted to spend some time doing in this video is talking about recessions and what they mean and what happens in them, and also what happens next. And quite a good article on this, which I will talk to some degree, is on Investopedia. So it's not particularly about recessions, it's about the business cycle. Any kind of market is made up of cycles. I spoke last week about the business life cycle, which is not the same as the business cycle. The business life cycle is the life cycle of any particular business. The business cycle is about the economy as a whole. Interestingly, this article talks about the popular misconception, but enough people use this definition of a recession that it is widely considered the definition of a recession. But what they're saying here is that when an economy gets stuck in this cycle, then that is what a recession actually is. But effectively, what happens is that GDP growth slows because consumers stop buying as much stuff, businesses stop investing as much, and this can be for various reasons. Interest rates go up, inflation goes up, consumer sentiment goes down, all of the above. Now, over time, because businesses aren't growing as much as they were, they need to try and optimize, they need to cut the fat in their businesses. So weak business functions can be cut out completely or closed down. People tend to be laid off. In bad recessions, people that work in companies might even be willing to take pay cuts. Smaller companies, unhealthy smaller companies, tend to die. And so over this time, unemployment begins to rise. Now, because people are spending less money, there's less money flying around the system, the prices of some things can come down. This doesn't mean that the prices that have gone up recently are going to come back down to the levels they were before, and this is actually very unlikely, but the level of inflation could come down quite fast, and then some things could become a bit cheaper too. There could be deflation in some areas. Now, this goes on for a while. It means that the government, this goes on for a while, and the government of this theoretical country is not able to raise as much money from its population, from the companies and people, as it used to be, because there are fewer people that are working, less taxes. There are fewer companies, less taxes. Companies aren't growing as much, less taxes. The general population is also becoming unhappier as time goes on. People want to work. They want to have money to buy things, to live a good life. And so a lot of political pressure is created during this time. At some point, the government will decide, okay, we need to step in, and they will begin to offer various types of support, either directly or potentially through their central banks. A very obvious example here is cutting interest rates. And then the whole process begins to reverse. And I think that China might be closer to the reversal of this than the leading countries in the West. And so this goes in the opposite direction, right? So the economic support provided by the government means that people have more money to spend. This means that companies are able to grow again, invest in themselves. More people making more money, more businesses making more money means more taxes to collect for the government. Everyone's happy, everything's growing, until they overshoot and overdo it once again. And then the government will begin tightening up. So this chart is a very neat representation of what happens during a recession. And something to bear in mind, even though recessions suck, they do need to happen from time to time. And in fact, the US Fed has never brought inflation down from the levels that it's at right now without a recession. So it's not entirely a grim picture. It is a resetting of the financial system. But one good thing about this is that recessions tend to be fairly short-lived, and then the subsequent expansions tend to be much, much longer, especially in recent decades. I'm not sure if the world is going to enter a recession. It seems as though certain countries are almost certainly going to experience some sort of GDP shrinkage. I don't have any crystal ball that allows me to predict the future better than anyone else. The machinery that we have for creating growth and then controlling growth in macroeconomics, they're very blunt. And while people are very critical of central banks, I think that they've got one of the hardest jobs in the world. So right now we might experience a soft landing where instead of getting a recession, we just get a little slowdown in growth, and then subsequently some kind of Goldilocks environment for growth beyond that. Or I think that certain countries will be entering fairly shallow recessions, which will hopefully crush inflation. And then once that entire system has been reset, central banks will once again have the tools to manage the economy effectively. So what should we be doing through these types of periods? I know that a lot of people will want to pull lots of money out of the stock market, but statistically this is a bad idea. Most of the best days in the stock market follow hot on the heels of the worst days in the stock market. So you could take your money out and you might avoid some of the worst days in the stock market, but you're almost certainly going to miss some of the best days too. I put out some numbers last week talking about this, and even if you just miss 10 of the best days in a decade, it can massively impact your returns over the long term. So I prefer to invest in companies that are able to weather the storm. They're not going to fail despite the macroeconomic conditions. Maybe their growth is impeded for a while, but also because they are strong businesses going into these kinds of conditions, they probably can make the best of this bad environment. There are a lot of zombie companies in the economy at the moment. Companies that haven't been able to grow for a number of years, they're always on the edge of failure, and these types of conditions usually push them over the edge. And the highest quality companies will then pick up the share of the pie that those companies were occupying. One good example, I haven't spoken about them for a while, is EasyJet, who have used the pandemic to their advantage. It's not showing in their share price yet, but I encourage you to look at their last earnings report. I think that they're going to come out of the pandemic even stronger than they were in 2019. So we want to pick those kinds of companies. One last thing I wanted to look at was the economic calendar. So there are lots of bits and pieces of data coming out this week. Some of them are very interesting. So the PMI data out of the UK is something that I will be going through in detail. But since I've been talking about GDP and recession so much, I just wanted to highlight that on Thursday at 1:30 BST, we're going to get the GDP quarter-on-quarter numbers for the US. So keep an eye out for that. All right, that's it for this week. I'll speak to you soon. Goodbye.